Good afternoon, dear students. I hope my audio as well as the screen is clear and visible. Yeah. So, in this live session, we will be discussing the RTP for May 2024, which has been released by ICI, Advanced Accounting. We'll go through the questions, the type of MCQs that are being asked that will help you to practice for the examination. As we are discussing, if you have any questions, if you have any doubt, feel free to ask me. And I hope all of your preparation is going on extremely well and you're preparing well for the examination. All right. So let's start without wasting much of our time. So first part is with MCQ based on case scenarios. Now here, what I would suggest for you to handle such situations in examination. If you see the question is very long. Okay, question is very long. So before reading the entire case scenario, what I would want you to do is quickly look at the question. So first question talks about when should RTS recognize revenue as per accounting standards. Second question talks about state with reference to accounting standards what would be the value of inventory. So second one is on inventory. Third one is accounting treatment of both grants mentioned above. So there are aspects around revenue recognition, inventory and grants. So once you have this understanding, what you should do is as you are reading the question, you need to pick up the relevant aspects. Okay, that is the whole idea. Now let's look at the case now. RTS Limited is engaged in the business of manufacturing of equipments components. So that is the business. Company has a contract with Indian Railways for a brake component which is structured in the following way. So they have a contract with Indian Railways. Okay. The company's obligation is to deliver the component to the railway stockyard while the delivery terms are X works. Now X works means, so sometimes you need to understand these technical terms. X works means from factory. The company is responsible for engaging a transporter for delivery. So, delivery terms are X works. We will deliver them at the factory, but we are responsible for engaging a transporter. Railways will send an order for a defined quantity. So, railway will place an order. Company manufactures the quantity and informs the railways for carrying out the inspection. Railways representatives visit the company's factory, inspect the components, and mark each component with a quality check sticker. So now here the entire process is they'll place an order, they'll come to the factory, and they will check each of the component. Goods once inspected by railways are marked with a hologram sticker to earmark delivery identification by the customer when they are delivered to the customer locations. So after inspection only the delivery will happen. Where will the delivery happen? Delivery will happen at the factory itself. The management of RTS is under discussion with the auditors of the company in respect of accounting of a critical matter as regards its accounting with respect to subsequent events after the reporting period. Now here, subsequent events after the reporting period, we didn't find anything in the MCQ. They have been checking as to which one of the following events after the reporting period provide evidence of conditions that existed at the end of the reporting period. Now, tell me one thing, all of this is not related to the questions given, right? So you have to be very careful in eliminating this information. They have given lots of information, but this information is not relevant, right, for this case study. But then moving on, so this part is done. The company has received a grant. Sorry, something is wrong with my pencil. Just give me a couple of moments. Moving on, the company has received a grant of 8 crores from the government for setting up a factory in a backward area. Out of this grant, the company distributed 2 crores as dividend. Now, that is one thing. The company also received the land free of cost from the state government, but it has not recorded this at all in the books as no money has been spent. Now, as far as grants are concerned, if something is received free of cost, we have to record it at nominal amount, and they have received grant to set up a factory. We can't distribute dividend out of this. So let us see what is the question asking. RTS has a subsidiary A Limited which is evaluating its production process wherein normal waste is 5%. 5,000 of input were put in the process resulting in a wastage of 300 metric ton. Cost per MT of input was 1000. Entire quantity of waste was on stock at the end of the financial year. So this is related to inventory. Now if you see, though they say it's a case study, there are 3 different aspects. A lot of information is not relevant. So depending on the question, we will figure out which is the relevant answer or which is the relevant option we need to be looking at with respect to each of the MCQs. Okay, now first MCQ, when should RTS Limited recognize revenue as per the accounting standards? The question is, when should we recognize revenue as per accounting standard? Applicable standard is accounting standard 9. Would your answer be different if inspection is normally known to lead to no quality rejection? See, even if inspection does not lead to quality rejection, we should understand that the customer has accepted the product only when the inspection is complete. So my answer will not change whether it will normally lead to quality rejection or not. So whatever is the scenario, only after the quality completion we can recognize revenue, right? So first, revenue should be recognized on dispatch of components. Assessment would not change even in case where inspection is normally known to lead to no quality rejection. That's the first one. Now, please understand, we are manufacturing product specifically for railways, and once they mark each component with a quality check, and goods once inspected by railways are marked with a hologram to earmark for delivery identification by the customer when they are delivered to the customer location. Means once the railways authorities have completed their quality inspection, they have accepted the product. Delivery is a mere formality. Okay. Second, so revenue should be recognized on dispatch. Dispatch is not relevant. Revenue should be recognized on completion of inspection of components. The assessment would not change even in case where inspection is normally known to lead to no quality rejection. So after the inspection is completed, we can say our obligation, the customer has accepted the product, and we can consider the revenue to be recognized. Revenue should be recognized on dispatch of components. No. Revenue should be recognized on delivery. Dispatch itself is not relevant, so delivery will not be relevant. Okay. Second, in respect of A Limited, state with reference to accounting standard, what would be the value of inventory to be recorded in the books of accounts? Now, here, if you see, $5,000 metric ton, cost per metric ton is 1,000 metric ton. So we have 5,000 metric ton into 1,000 metric ton, and there will be a normal wastage of 50. So you have 950 metric tons. So the cost per unit will be 5,000 into 1,000 divided by 950. That is 5263. Okay, this is the cost per metric ton. How did we get that? You input 5,000. Sorry, my mistake here. I took 1,000 as the quantity. So you input 5,000 metric ton. Cost is 1,000, and the normal loss is 5%. Normal loss is 5%. Means out of this 5,000, 5% will be lost. That is 250 will be lost. So how much unit we will get? We should get 4750. So cost per metric ton is 5000 into 1000 divided by 4750. That gives us 10,000. 1052.60. Okay, that is the number. Now, how much is the actual output? Actual output is 4700 only, because the question says they have wasted 300 metric ton. So actual output is how much? 4700. Extra 50 that is lost, that will be considered to be abnormal loss. So what is the valuation? 4700 into 10526, we get 4947368. This is the right answer. Now here, straightforward way to understand that is 50 lakhs is not possible. 47 lakhs is also not possible, because these are direct multiplication of 1000, and this also is not appropriate because we are losing out more. So option D is the correct answer. Okay. Then third one, please guide regarding the accounting treatment of both the grants mentioned above in line with the requirements of accounting standard 12. Now first thing we have understood, distribution of dividend is not correct. First statement says distribution of dividend is correct, so this is not right. Distribution of dividend is not incorrect, so this can be one option. Distribution of dividend is correct, this cannot be an option. Then out of these two, not recording the land in the books is correct. No, this is not correct. You have to record at nominal value. Now, 2-3 things you would have realized here. One, we can eliminate the options and we can get to the answers. That is one aspect. Okay. Second, you don't need to present as if you are preparing or you are writing a full mark, question in the examination, right? So, because you are not writing, just a second. Because you are not writing a full mark question in the examination, don't worry about presentation. Even a rough calculation is sufficient. So that should be your strategy, right? So option D is the correct answer. Now next one. Now if you observe here, what they have done is they have given normal questions as MCQs. So one advantage you will have here is presentation, you will save time. Second, you can choose from one of the options, and because you are choosing from one of the options, the accuracy will be higher because you know what will be the answer, right? I hope it is clear so far. If any questions, please let me know on that. Then, moving on to the second question, that is another MCQ. GAN Limited borrowed 10 crores for construction of a plant at the rate of 10% per annum. The construction was being carried on and out of borrowings. 4 crores was temporarily placed in a fixed deposit at the rate of 6% per annum. Interest earned 24 lakhs. At the year end, how much cost of borrowing GAN Limited will capitalize? Now, whenever there is a borrowing, how do we capitalize? We will see how much is the interest paid minus income on temporary investment. So interest paid, no. Interest paid on 6 crore, but investment is not given. Interest paid less income on temporary investment. So option C is the correct answer. Pretty straightforward. You must be able to score 2 out of 2 in this type of questions. Then theoretical question, carve outs and carve ins in Ind AS. So this is where Ind AS are different from IFRS or IAS. So some things don't match the accounting treatment or the economic requirement of our country. So based on that, some items are excluded from Ind AS or some items are added. That is what is called as carve ins and carve outs. Then the fourth question is on maintenance of capital, right? So Shiva started a business on 1st of April with 15 lakhs represented by 80,000 units of 25 each. During the financial year ending on 31st March, he sold the entire stock for 35 each. In order to maintain the capital impact, calculate the maximum amount which can be withdrawn by Shiva for 22-23 if financial capital is maintained at historical cost. Now what they are saying, how much can they withdraw, right? Now how much did we introduce? we introduced 80,000, right? And into 25 is what was introduced. How much did we sell it for? 80,000 into 35 is what we sold it for, right? So 80,000 into 35, if you do, 8 3s are 24, 8 5s are 40. So this makes it 28 lakhs. And we had introduced 15 lakhs. So 15 lakhs, 80,000 into 25. 80,000 into 25 is not 15 lakhs, it should be actually 20 lakhs. So 80,000 into 25, what you need is 20 lakhs. So basically, maybe he introduced 15 lakhs, bought 80,000 units of 25 each, maybe took loan or something else. Doesn't look to be appropriate in terms of the question. Anyways, closing, we sold it for 28 lakhs and we purchased worth 20 lakhs. So 28 minus 20, 8 lakhs is the surplus. Now the question says, if financial capital is maintained at historical cost means how much do I need? I need 80,000 into 25, that is 20 lakhs. I have 28 lakhs in hand. So I need only 20 lakhs because I am maintaining it at historical cost. So 28 minus 20, I can withdraw up to 8 lakhs. So that my capital at historical cost is intact. Okay. Then based on the criteria for rating of non-corporate entity, categorize the following as level 1, level 2, level 3 and level 4. For this we have a detailed discussion in the class, and also there is a separate video on YouTube if you want to refer to it. For the following, for compliance of accounting standard in India. Okay, first, Rama Textile, whose turnover excluding other income exceeds 10 crore but does not exceed 50 crores. So this comes under level 3. Star Industries is having borrowings in excess of 2 crores but not in excess of 10 crores. This also is level 3. Newman Industries is having less than 50 borrowings including deposits less than 50 lakhs. This is level 4. SS Finance is a financial institution carrying its business in India since last year. So because it's a financial institution, it's a level 1 entity. DD Finance, holding company of SS, because it's a holding company, level 1. Reliable Cooperative Bank, carrying on banking business, again level 1 entity. Okay. So again, straightforward application. That from the following particulars, moving on to the next one, cash flow statement on accounting standard 3. From the following particulars, calculate cash flows from operating activities. So they have given retained earnings, depreciation, loss on sale of machinery, provision for tax, interim dividend paid, premium on redemption of preference shares, profit on sale, refund of tax. So that is what they have given, and they have given additional information of current assets and current liabilities. It is not repair expenses, it is prepaid expenses. Okay. Now, this actually should be referred to as net profit. They have asked us cash flow from operating activities. So you will take the net profit. On net profit, you will add back the depreciation, which is non-cash. Loss and sale of machinery does not belong to this particular activity. So this also will add back. Provision for tax, you will show it separately. Provision for tax, you will show it separately. So this will keep it outside. Interim dividend paid, this is financing activity, not to be considered. Dividend paid, again financing activity. Now, because they have given retained earnings, okay, so this question is not fully complete in that sense. Because they have given retained earnings, this retained earning is after adjusting the dividend paid. So I will not consider this as net profit. Retained earning is after adjusting the dividend paid. Now, because it is after deducting the dividend, to arrive at the net profit, we will add back the dividend. So what you will do, whatever dividend is declared, you will add back. Okay, not an appropriate way of asking question. They should have actually said amount transferred to retained earning or opening or closing balance of retained earnings. Okay, then premium payable on redeemable preference shares. Now, whatever premium you pay on redeemable preference shares, this premium is treated as an expense. So this again will go as a financing activity, not under the operating activity. Okay, so this also you will add back. Profit on sale of investment, Profit on sale of investment, again that activity is something which is not pertaining to your investment activity. So that also you will have to adjust it again, because it's a profit, you will reduce that amount of 10,000. Then refund of taxes 1,000. So refund of tax and provision, you will do the adjustment and show it as a separate line item. Okay. So you have trade receivable opening and closing. So we know the formula for trade receivable, opening minus closing. So opening minus closing is a negative number, you will show it as a deduction. Trade payable, closing minus opening. Provision for tax, along with the provision for tax given above, you will try to do the adjustment. Prepaid expenses, again same treatment of current assets. Outstanding expenses, again same treatment of current liabilities. Okay. So that is how you will prepare. You can do it on your own, nothing complicated. And just a moment, my pencil got discharged, Apple pencil. The next one, on related party disclosures. A Limited entered into an agreement with Mr. Bola for running a business for a fixed amount payable to the later every year. So basically they have entered into an agreement with Bola. Contract states that day-to-day management of the business will be handled by Bola, while all financial and operating policy decisions are taken by the board of directors. Mr. Bola does not own any voting power. You are required to suggest how the transaction will be treated as a closing date on 31st March for the purpose of AS 18. Now, please remember, first one, you have hired a manager to manage the day-to-day operation. Just because he is a manager, he will not become your related party. Either he must have control, that is voting power majority, or he must have significant influence. He must be able to participate in operating and financial policy making decision. Does he participate in that? He does not participate. Can he direct the board of directors? He cannot direct the board of directors. Can he control the board of directors? He cannot control the board of directors, and hence this is not a related party. Sri Manoj, a relative of key management personnel, received remuneration of 350 for his services in the company for the period 1st of April to 30th of June. On 1st of July, he left the service. Now here what you need to understand is, even if he left the service during the period, you have to disclose the related party relationship and the related party transaction. Okay. Just because he has left during the year does not mean you will not disclose it. So you have to disclose. Then, on accounting standard 24, discontinuing operation. Arzo Limited is in the business of manufacture of passenger cars and commercial vehicles. Company is working on a strategic plan to shift from the passenger car segment to the commercial vehicle segment over the coming 5 years. However, no specific plans have been drawn up for sale of neither of the division nor its asset. As a part of the plan, it has planned that it will reduce the production of passenger cars 20% annually. It also plans to commence another new factory for the manufacture of commercial vehicles plus transfer of employees in a phased manner. These plans have not been approved from the board of directors, and the new factory of commercial vehicles has not started. You are required to comment if mere gradual phasing out can be considered to be a discontinued operation. Now, when we talk about discontinued operation, what we are saying is, as a part of a coordinated plan, the management is disposing of a significant operation or significant component of the entity. Whereas, if there is a gradual phasing out, it need not mean that it is a discontinued operation. I am gradually reducing the production and I am starting at a different place. That need not be a discontinued operation. Second thing you have to keep in mind here is, board of directors have not approved of the plan. So it is just that management has decided gradually they will reduce the scale and they will phase it out. That should not be considered as discontinued operation. So when you are answering, you have to define what is a discontinued operation, and you have to say that gradual phasing out of the activities is not considered to be a discontinued operation. So that angle you have to cover it. Okay. Then accounting for investment, ABC holds 2000 15% debentures of 100 each in XYZ Limited as on April 1st at a cost of 250. Interest is payable on 30th June and December 31st each year. Following details of 15% debentures purchased and sold. So on May, something purchased come interest, sold X interest, purchased X interest, sold come interest. So a very straightforward question. This regularly you would have practiced in your classes wherever you have taken. So this you can do it on your own. There is nothing complicated which I need to explain. Then again on borrowing cost. Standard question. These type of questions have been repeated again and again. H Limited began the construction of a new building on 1st of April. It obtained a special loan on 6 lakhs on 1st of April at the interest of 12% to finance the construction. The company's other outstanding two non-specific loans on 1st of April is 30 lakhs and 54. So for this you will calculate the weighted average rate and rate. Expenditure incurred were as follows: 12 lakhs, 15 lakhs, 27 lakhs, 7 lakhs, 20,000. Building was completed on 31st of March. You are required to give the accounting treatment for the above, right? So how do you do the accounting treatment? First, what is the weighted average? Now for weighted average, what you will do is 30 lakhs into 14%, that is 4 lakh 20,000. 54 lakhs into 16%. 8 lakh 64,000. The total of this is 8 plus 4, 12. 12 lakhs 84,000 divided by 84,000. So 12 lakh 84 divided by 84. You get 15.28% or rounded off to 15.29%. Okay, that is the weighted average rate of interest. Okay, which we also call as the capitalization rate. Now, how much interest should be capitalized? Now, what you need to understand is you have specific borrowings of 6 lakhs on 1st of April and you have remaining expenses. Okay, now these expenses are not incurred on an even basis. If you see this 12 lakhs, this 15 lakhs, this 27 lakhs, this 7 lakh 20,000, they are not incurred on even basis. They have been incurred on a spread out basis, right? So what you can do is from the first part, so whatever 12 lakhs has been spent, this you can assume that 6 lakhs has been spent from this and balance has been spent from the common borrowing. So up to 6 lakhs you will apply the rate of interest that is applicable to this, which is 12%, and after that whatever amount has been spent, whatever amount has been incurred, on that you will apply the average rate of 15.29%, and then you will solve the you will get to the answer as to how much amount has to be capitalized. Okay, so the key is to calculate the weighted average borrowing, and then they have taken a loan on 1st of April. Expenditure has been incurred on 12 lakhs on 1st of May, 1st of July. So out of this 12 lakhs, 6 lakhs is specific, 6 lakhs is general, and then remaining all the general borrowing. Okay, so that is how you will have to calculate the amount. Then accounting standard 19 on leases. Suraj Limited wishes to obtain a machine costing 30 lakhs by way of lease. Okay, so not my name, I write my name as Suraj. The effective life of the machine is 14 years, but the company requires it only for the first 3 years. It enters into an agreement with Star Limited for a lease rental of 3 lakhs per annum payable in arrears, and the implicit rate is 15%. Chief accountant of Suraj Limited is not sure about the treatment of these lease rentals and seeks your advice. Annuity factor 15%, 3 years is 2.28. Now, very unlikely that a lease of 3 years period will be a finance lease. So basically here we have to decide whether it is an operating lease or a finance lease. Okay, by term it is not a finance lease. Second thing is present value of the lease payment. So 3 lakhs into 2.28. 3 lakhs into 2.28 works out to how much? 3 into 2.28. Present value of lease payment works out to 6.84. So this is not a finance lease, hence it is an operating lease. If it's an operating lease, then you have to charge the rental income on a straight line basis over the tenure of the lease. Okay, very simple, nothing specific or nothing complicated, right? Then AS 14, Naresh Limited had the following transactions during the financial year 22-23. Okay. First, Naresh Limited acquired running business of Sunil Limited for 10,80,000 on 15th of May. Fair value of Sunil Limited net asset was 5,16,000. Naresh Limited is of the view that due to the popularity of Sunil Limited product, its goodwill exists. So there is some form of goodwill, or there is some amount of goodwill on acquisition. Okay. Naresh Limited had taken a franchise on July 22 to operate a restaurant from Sankal Limited for 1,80,000 at an annual fee of 10% of net revenue after deducting expenditure. The franchisee expires after 6 years. Net revenues were 60,000 during the financial year 22-23. So here they have taken a franchisee for 1,80,000 and at annual fee of 10% of net revenue. So what you will do, 1,80,000 that you are paying for franchisee, that will be considered to be an intangible asset, and this intangible asset will be amortized over which period? Over a period of 6 years. Okay. Then Naresh Limited incurred cost of 240 to register a patent for its product. They expect the product life to be 8 years. So this actually should be more from point of view of accounting standard 26 and not accounting standard 14. Just because first question is AS 14, they have put everything under AS 14. It is more from AS 26 angle and not AS 24 angle, right? Now here what we need to understand is, first, how much is goodwill? 10,80,000 minus 5,16,000. Okay, so 1080 minus 516, how much will that be? 1080 minus 516, it will be 564. So 5,64,000 will be the goodwill. Now this goodwill they have acquired on 15th of May. You can amortize it over a period of 5 years. So 564, 123 divided by 5, it is 1,12,800. But because it is on 15th of May, okay, so you will amortize it only for a period of 10.5 months. Okay, so what you will do, 564, 123 divided by 5 multiplied by 10.5 divided by 12. So that will be the depreciation part. Here, franchisee they have taken on July 22. So even if you assume from July, August, September, October, November, December, January, February, March. So here the depreciation or amortization will be 1,80,000 into 9 divided by 12, 1,80,000 divided by 6. Okay. Though in the suggested solutions they have done for full year, that is not appropriate. On 20th August 22, they incurred a cost of 240, expected life to be 6. Oh, okay, sorry. They follow an accounting policy to amortize all intangible assets on a straight line basis over the maximum period, taking a full year amortization. So here my thing is wrong. So it has to be full year only. 564 divided by 5, 180 divided by 6, and 240 divided by 8 will be the amortization. Goodwill on acquisition of business is to be amortized over 5 years. Prepare a schedule showing the intangible assets section in the Naresh Limited balance sheet. So very simple and straightforward. Then moving on, accounting standard 15, implemented first time for CA intermediate after a long period of time. Okay, so we used to have this standard when we were students in CA inter itself. Just a moment. Now, on AS 15, Hello Limited belongs to the manufacturing industry. The company received an actual valuation for the first time for its pension scheme, which revealed a surplus of 12 lakhs. It wants to spread the same over the next 2 years by reducing the annual contribution to 4 lakhs instead of 10 lakhs. Average remaining life of the employees is estimated to be 6 years. You are required to advise the company on the following items from the viewpoint of finalization of account, taking a note of the mandatory accounting standards. Now, what they have done is, or what they have said is, there is a surplus of 12 lakhs. Now, please understand, actual gains or losses as per accounting standard 15, you have to credit it to P&L. There is no concept of deferring it and amortization under accounting standard. So, this treatment is not valid. Entire 12 lakhs, you have to credit it to the P&L in the year in which the surplus arose. Okay. Then, accounting standard 4, contingencies and events occurring after the balance sheet date. Surya Limited follows the financial year from April to March. It has the following information. Suit against the company's advertisement was filed by a party on 5th of April claiming damages of 5 lakhs. Okay. Then, company sends a proposal to sell an immovable property for 45 lakhs in March 23. Book value of the property is 30 lakhs on the year end. Deed was registered on 15th April. Keeping in view the provisions of AS4, you are required to state with reasons whether the above are to be treated as contingencies, adjusting events, or non-adjusting events occurring after the balance sheet date. Now, the first one, suit has been filed against the company is a contingent liability, but the condition itself came on 5th of April. When the condition itself came on 5th of April, you will not adjust that in the balance sheet. You will not treat it to be an adjusting event. Okay. So, that is one thing. So, because it is not existing on the date of the balance sheet, hence it will not have any impact on the existing financial statement. No adjustment has to be done. In the second case, it says the company sends a proposal to sell an immovable property in March 23. The deed was registered on 15th April. Now here we need actually more information. The question is not clear as to just because I have sent the proposal, has the other party accepted it? Have we entered into some memorandum or have we entered into some draft agreement? If that is the case, that yes, we have entered into a draft agreement, we have received some amount, we have agreed, and only the registration was pending, then you can consider it to be an adjusting event. If it was only at initial negotiation state, it cannot be considered to be a adjusting event. So accordingly, we will have to give the answer. Again, I'll have to charge it. Sorry. Right. So I'll just read the question, but you'll not be able to see it. So. The next one on A7, the following data is provided for Mrs. Raj Construction, contract price 85 lakhs, material issued 21 lakhs, out of which material costing 4 lakhs is still lying unused at the end of the period. So out of 21 lakhs minus 4 lakhs, only 17 lakhs has been issued. That is the cost. Okay. Then labor expenses for workers engaged at the site 16 lakhs, out of which 1 lakh is still unpaid. Entire 16 lakhs will be the cost. Specific contract cost 5 lakhs. Okay. Subcontract cost for work executed 7 lakhs, advances paid to subcontractors 4 lakhs. Entire 7 lakhs will be your expense. Right. So how much is the expense? 17 here plus 16, 33, 38 plus 7, 38 plus 7 is 45. Further cost estimated to be incurred 35. So 35 plus 45, it is 80. What is the revenue expected? Revenue expected is 85. Okay. You are required to compute the percentage of completion of the contract revenue and cost to be recognized as per accounting standard 7. Now, what is the completion rate? Total is 80. We have already spent 45. 80 out of 45. So, 45 divided by 80, if I do, you get 56.25%. This is the completion rate. And out of this 85 lakhs into 56.25% is the revenue to be recognized. Okay. Then, AS9, following information of BS product is given. Goods of 2 lakhs sold to Den Limited on 20th March, but at the request of buyer, these were delivered on 10th of April. Sale date is 20th of March. Even if the buyer has asked to hold the delivery, we can recognize the sale on 20th of March itself. Okay. So, if the, The delivery has been held because of the buyer's request. Delivery has been held because of the buyer's request. What we will consider? We will consider it to be the sale for the year ended 31st March of year 23 only. On 15th March, goods of 3 lakhs were sent on consignment, basis of which 20% of the goods unsold are lying with the consignee as at 31st March. So out of 3 lakhs, only 80% is sold, that is 2,40,000 should be recognized as revenue. 4 lakhs worth of goods were sold on approval basis on 1st of December. Period of approval was 3 months, after which they were considered as sold. Buyer sent an approval for 75% up to 31st January. No approval or disapproval received for remaining goods until 31st March. So 4 lakhs worth of goods have been sent on 1st of December. What is the period available? 3 months period is available. Right? Now when 3 months period is available, what should we do? We should say December, January, February. By February, either we should get approval or we should get the rejection. Now what has happened? We got approval for 75%. For balance, nothing has been received till 31st March, which means we will assume that the product has been approved by the buyer and hence entire 4 lakhs will be the revenue. Apart from above, BS Product Limited sells goods to dealers. One of the condition is that interest is payable for delayed payments by the dealer. Percentage of interest recovery is only 10% on such overdue outstanding due to various reasons. During the year, company wants to recognize entire interest receivable of 60,000. Now here, please understand, they charge 2% per month, but recovery is only 10%. Recovery is only 10%, which means they are recovering only 10%, that is 50,000. But they want to recognize 60,000. Is that possible? No. You should recognize only 50,000 because that is the recoverable amount or recovery amount. And accordingly, the revenue to be recognized, total revenue. So basically add 1, 2, 3. This is not revenue, but again, all 4 put together will be the total revenue. Okay. Then consolidated financial statement. This question is a slightly different. Rather than discussing, I would want to give you a full-fledged solution with explanation because there is an angle of preference shares involved here. So we'll do that separately. You will get it separately as a separate video. Okay. Preparation of financial statements, simple, straightforward question. So this you can practice on your own. There are no critical adjustments, as far as the P&L is concerned. Then buyback of securities. Mukti Limited provides the following information as on 31st March. Land and building, plant, non-current asset, trade receivable, inventories, cash, so and so. Then securities premium, general reserve, E&L, 10% debentures, unsecured loan, trade payables. Okay. On 21st April of 23, the company announced to the buyback of 15,000 of its equity shares at 15 per share. For this purpose, it sold all its investment for 2.5 lakhs. So what they have done, they have sold the investment for 2.5 lakhs. That's the first thing that they have done. Then on 25th April, the company achieved the target of buyback. So when did it get completed? On 25th April, everything got completed. Okay. Then on 1st of May 23, the company issued one fully paid up share of rupees 10 each by way of bonus for every 8 shares held by the equity shareholders. So after buying back, whatever is remaining shares, on that they have, issued bonus shares. You are required to pass necessary journal entries for the above transaction. Now here, no need to calculate or buyback test and all that is not needed. What is needed is, the company announced for this purpose it sold all its investment for 2.5 lakhs. So what is the investment? Investment here is 2 lakhs. You have sold it for 2.5 lakhs. So 50,000 of profit you will recognize there. Then on April 25th, it is completed. What is completed? Buyback. How many buyback? 15,000 into 15. That is 2,25,000. You will credit to bank. Face value. Face value is 10. So 1,50,000 you will debit to share capital, and balance you can debit to securities premium account because you have security premium balance available, so that can be used. So 75,000 securities premium account. Okay. Then after you have bought back, what happens? Share capital is 1 lakh equity shares, 15,000 is bought back, so you are left with how much? 85,000 shares. On this 85,000 shares, you are issuing a bonus share. Okay. You're issuing a bonus share. Now, when you're issuing a bonus share on that, how much should be issued? 85,000 divided by 8. 85,000 bonus share, you can use the CRR and you can issue the bonus share. So simple, you can directly do it. Then accounting for reconstruction of companies. As a part of reconstruction scheme of Getting Better Limited, the following terms were agreed. Shareholders to receive in lieu of their present holdings 10,000 shares. Just a moment. Accounting for reconstruction of companies. As a part of reconstruction scheme of Getting Better Limited, the following terms were agreed upon. Shareholders to receive in lieu of their present holdings 10,000 shares of rupees 50 each, the following. 15,000 fully paid up shares of rupees 10 each. So from 50 it will come down to 10, but 10,000 will become 15,000. 12% fully paid up preference shares to the extent of 2/5 of the total equity share. So 10,000 into 2 by 5, they'll get the preference shares. To pay them 50,000 and transfer the remaining to the reconstruction account. Balance you will pay 50,000 and you will transfer the remaining to the reconstruction account. Now this is a question again where normally these kind of adjustments are not seen. So what you'll have to do is, first, present holding 10,000 shares of 50 each. So what you will do, you will debit the share capital account. You will debit the, so I'll just write it down here. So now what you can do is, first, present holding 10,000 shares of 50 each. Total holding, that is 10,000 into 2 by 5, 4,000. So preference share capital 4,000 of 12% preference share capital to the extent of 2/5 of the total equity shares holding. So they have not mentioned the count. So this is the count, 4,000 shares. 2/5 means 50 into 10,000, 5 lakhs. 5 lakhs into 2 by 5, that is 20,000, 2 lakhs. Okay, 2 lakhs. Then you will pay cash to bank. You will go off to accrued interest of 56,000 was waived off for 3 months of the total amount and the remaining being paid in cash. 14% debentures of nominal value of 2 lakhs along with accrued interest of 56,000 was waived off for 3/4, not 3 months, for 3/4 of the total amount and the remaining is paid in cash. Now what does that mean? It basically means 2 lakhs plus 56, 3/4 is waived off. So 256 into 3 divided by 4, 192 is waived off, balance has to be paid. So what you will do, 14 debenture account debit 2 lakhs, interest payable 56,000, to capital reduction 1,92,000, to bank you will pay 64,000, that is 256 into 1 by 4, and then you can prepare a ledger and figure out how much is the balance in the reconstruction account that has to be transferred to the capital reserve. Now if you look at this particular RTP, most of the questions are simple, straightforward, other than the single question on consolidated P&L, for which we'll be providing a separate detailed solution. If you have any more doubt in this particular RTP, you can feel free to put it down as a comment and we'll be more than happy to address them. Thanks for joining in and have a nice day.